Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets.
Hey everybody, welcome back here, Minds on the Markets. 2 weeks have passed. Jeff, nothing's happened. It's been a really quiet 2 weeks, right? Oh my gosh. Tongue in cheek, Moody's downgrade, big beautiful bills, 5% 30-year bonds. My goodness, just a lot going on. But hey, maybe a more interesting story that's gotten a little bit buried is what's going on in Japan. What was it, about a year ago? We were talking about the busting the yen carry trade. What's going on right now?
That's exactly where we were just short of about a year ago, last summertime, and now new issues where again Japan is in the macro focus, and it's in bad terms, right? I mean, if you think about what's occurring, you mentioned the sell-off in U.S. Treasuries. That's the world's biggest bond market. Well, Japan is the world's second biggest bond market, and the 30-year JGB, Japanese government bond there. It was forever. I mean, really forever. It was under 1% over there. And then around Halloween, it got to 2%. And then last week, it got to 3.14. And it's a cost of capital issue. It's a stability issue. It's a volatility issue. Big sell-off. Now, the Ministry of Finance over there did come in over the weekend and basically say, okay, we're going to try to not issue so much distant paper and try to shorten the maturities of the new debt that we put out. And that got a rally to 288 on that yield. But it's now just one of these things that's now in the conversation, and it's a cloud over markets.
Yeah, I mean, it's interesting, the focus here on our government bond market. And you've actually seen 30-year yields rise more in the UK, in Germany, and in Japan. And in this case, talking about Japan, the increase has been 3 times the size of what we've experienced here in the U.S. So let's bring it back for a second to the U.S. 5% 30-year. We didn't get a 5% 10-year, only got up to about 460.
Right.
Is a 5% 10-year trouble for our equity markets?
Well, that's the question, and you don't know. I mean, you have to ask the next person, I suppose. But there is some level where the market likes to get freaked out. I mean, we had said this a lot. You and I both were saying this back in 23. Bond market sell-offs were being accompanied by stock market sell-offs. Although in 23 you never really saw them because the stock market went ripping, but you could see them in these 1 or 2 or 3% moves. And then in the back part of 24, from about the end of summer clear to the end of the year, the bond market did sell off. You went from mid 3s to high 4s on a 10-year T-note in this country, and stocks were okay. Stocks were just fine. And you had the Trump trade, you had the American exceptionalism concept after the November 5th election. Stocks were up about, we tallied it was like 4% during the bond market sell-off of the essentially the fourth quarter of 24. But lately, as you're going to have to try to figure it out. We don't know yet what were the implications of when you get to 4.7, 4.8, 4.9. And then also if that's now conspiring with a further sell-off in JGBs as well. Is it that in the past you had this one punch and now you get a 1-2 punch? And I'm wondering if that's one of the big obstacles for stocks this summer.
So here we are. We're just about finishing up the last few days of May. Is it sell in May and go away? What is it, Jeff? Set us straight.
That's a risk. I think sell in May. Well, look, do you still get a hat tip to sell in May if you sell in the first week of June? Because May is essentially over. But here's the thing: we had, call it 2 risks in the market. That if bonds reach some level that nobody knows, that stocks won't like it. And then also the trade war, of course, the trade war, which we haven't even talked about. But now there's this third one, which is this other bond market as well. So you got these 3. Now, those 3 are all adverse potentialities. Right now, Q1 earnings growth for the S&P 500 were plus 13% year over year. And then you take things like a composite global PMI, which came in the other day at 52, which is expansionary, which is positive. So those are good portents. But now you got these 3. The U.S. bond market with a question mark, the trade war, who knows where that's going to go, and the Japanese bond market. Any of those three end up having some sort of pie in the face this summer, and I think maybe those sell in May people might be all right.
All right, then. Let's leave it there. Hey, everybody, if you like what you hear, please tell your friends, tell your neighbors, tell your family. We'll be back in 2 more weeks, and hopefully there'll be more fun and excitement for the markets. Take care, everybody.